My name is Anne Sudaka, and welcome to this video session where we are discussing IAS 12. IAS 12 is highly examinable at a proficiency level of level 3, which you are supposed to be able to identify IAS 12 issues, to make simple and complex calculations, to make complex disclosures. I would also encourage you to use this video before class and post class. Try to use this video 3 or more times for you to understand the nitty-gritties of IAS 12. IAS 12 for us is very important because it integrates very well with the Zimtex course. It is also highly applicable in practice. If you are in an audit firm, you should be able to review, to prepare tax calculations and disclosures in financial statements. If you are working in finance, you should be able to prepare and calculate deferred tax, income taxes, and connect it with tax. This part, which is part 1 or section 1, talks to the income tax framework, just to give you an overview of IAS 12 and the issues, and the subsequent parts will then go in and zero into specific sections. So first of all, the learning outcomes expected out of this part 1 talks to what is the objective of IAS 12 as a standard. What are the income taxes in relation to IAS 12? What is the relationship between IAS 12 and Zimtex course? The nature of type of income taxes, the nature of types of income earned by an entity. We will also look into the relationship between income and the income taxes. We will also look into the relationship between current and deferred tax. And lastly, we'll look into the composition of the tax expense, especially for the profit and loss account. So, the objective of IAS 12 is to prescribe an accounting treatment or to provide accounting treatment for income taxes. I'll emphasize income taxes. Further, IAS 12 will go a little bit deeper in talking about current tax, which is the tax that's supposed to be paid now to the tax authority, to ZIMRA, as well as future tax consequences, which are referred to as deferred tax. Now, what do we call income taxes? Income taxes are taxes that are levied or that are charged to local domestic income or foreign income or taxable profits earned by an entity from a Zimbabwean source. I'm trying to connect here the language of tax so that the integration happens well. So it's an entity makes a domestic and foreign income from Zimbabwean source, and that is taxed. And the IAS 12 focus on the accounting treatment for that tax. The income taxes for local income is prescribed in the Income Tax Act, whereas the income tax from foreign entities is prescribed in the country in which that income has been made, and the income tax allows an exemption to double taxation. So the connection would be normally on the double taxation. An entity also makes income which could be called capital gains income. That will be taxed under the Capital Gains Act, Chapter 2301. An entity also makes investment income, like dividends, and that will be taxed under the Income Tax Act, but with regards to dividend withholding taxes. Let's now go and compare IAS 12 and the Zimtex course, which is one of the courses that you'll be doing in CTA. So if we, just to remind you, the courses, we've got applied accounting, where IAS 12 will be examined and learned. We've got management accounting, we've got audit, and we've got Zimtex. And just to show you the difference between IAS 12 income taxes and Zimtex, is IAS 12 focuses on income tax for reporting entities, in other words, for an entity, and the accounting treatment for income tax, and we'll call it normal corporate tax, capital gains tax, and withholding taxes. IAS 12 mostly focus on the calculation and accounting treatment of taxes, and both current and deferred tax. Whereas Zimtex course does not only cover corporates, it covers also individuals. It also covers all taxes, not only income taxes. It covers all taxes, which includes VAT, capital gains, estate duty for both individuals and corporates. Its main focus is prescribing the principles of taxes, the calculation of the tax which is payable in a year tax assessment, year of assessment. Let's look at the nature of income taxes, or the nature of income. For one to understand the nature of income, we have to look into the profit and loss account and the other comprehensive income. By looking at the profit and loss account of an entity, we have what we call the trading income. Trading income comes from trade, from what a business has been primarily set to do. So as an example, CAA has been set to provide tuition. So the trading income is where you find revenue from tuition and all costs of sales directly linked to. If you take an entity like Delta, its business is selling or trading of beverage. So revenue from beverage and the cost of sales with regards to that. Those two lines gives us what we call the gross income, the gross profit. So gross profit is income from trade, and it is taxed in the normal tax or in the income tax. And it also makes other income. Other income in form of dividends probably received. It may be profit from savings accounts, it may be profit from disposal of land and buildings, it can be any other income that an entity which is incidental, not from primary activities. Some other incomes that an entity can make are profit, investment income, like share of profit, which can be shown separately, or share of profit from associates, or share of profit from joint ventures. An entity also makes other income from remeasurement of assets and liabilities. An example of those are what is found in the other comprehensive income, which is gains from revaluation of property, remeasurements of defined benefit pension plans, share of other comprehensive income of associates, cash flow hedges available for sale, which is now what is called fair value adjustment from fair value through OCI financial instruments. These are the income, and mostly, as you're going to study them in the future, they mostly arise from remeasurements of assets and liabilities. So, if we want to then go back and really look at how an entity earns income, an income therefore earns income from trade. Income from trade coming from ordinary activities or primary activities of an entity. As shown, an entity makes income from disposal of capital assets, which is income received or receivable from sale of capital specified assets. We're talking about profit from or loss on actual disposal, fair value gains and losses, some are in the profit and loss, some are in other comprehensive income, revaluation surpluses. We've got also investment income or investing income, which is dividend income, interests, or even royalties. But here we're mostly specifically focusing on the dividend income. Now, we want to connect the nature of the income made by an entity to the nature of the tax. That's our main goal. So, let's look at the nature of the tax as we spoke. There's normal corporate tax. And normal corporate tax is tax on income from trade or ordinary activities of an entity from a ZIM source, mostly calculated at a global level as gross income from trade plus any special inclusions, less general deductions, less special deductions accrued in a year of assessment. This is exactly how we speak about this from tax as a course. Remember, we agreed to say we need to see the link between IAS 12, income taxes, and ZIM tax as a course, which is normal tax. Capital gains are taxes on income received or receivable from sale of capital specified assets. And to calculate the taxable income, you take your proceeds or deemed proceeds less the best cost or allowable deductions. Whereas tax on dividends specifically is the tax on dividend income received or receivable. And it's that dividend that has been received or will be receivable in future. Now, let's then see the relationship between the nature of income and the tax in one. So income from trade is taxed under normal corporate tax, whereas income from disposal of capital assets is taxed under capital gains tax. Let's specify or let's emphasize specified assets. So the Capital Gains Tax Act specifies certain assets that will generate or trigger capital gains. Not all assets will trigger. As an example, if I sell my car, or if an entity sells its car or vehicles, that would not cause capital gains tax. But if an entity sells land and buildings are specified assets, that could cause capital gains tax. Investing income, which is dividend, will be taken under dividend withholding taxes. So that is the link, and it's very important to understand that flow and that connection. And I think it's also very important even for understanding of the ZIM tax as far as corporate tax is concerned. Let's now bring the concept of current and the so-called deferred tax on income. Under normal corporate tax, an entity makes income. Some of the income is supposed to be taxable now. As an example, the Income Tax Act requires that income is taxed at the earlier of accrual or receipt, meaning you are taxed when you accrue a debtor, when you have sold your goods, even though it's before receiving money, you are taxed. Or when you receive income, even though you have not yet delivered the goods or the services, you are taxed. So for that income, the amount that you're supposed to pay to ZIMRA now, that's what we call current tax in the current year. But there's a process of calculating it as prescribed by the Income Tax Act to calculate your taxable income in the current year of assessment. Then you may have certain adjustments of current tax from prior year, where there may have been some differences that makes you to be able to pay the adjusted prior taxes, and that applies in the current year as well. We call those over or under. We shall go into detail with regards to those in part 2. The second part under normal corporate taxes, that part of the tax where the income or the expenses have been incurred in this period, but the actual tax payment to Zimra will happen in the future, which is what we call deferred tax. So, to emphasize again, for deferred tax, the event has happened now under accrual base of accounting. The event has happened now, so income may either be in the profit and loss or in other comprehensive income. Because we've accrued this now, we should show the tax consequences now, but the actual payment of that tax may be in the future. Whereas for current, the income has been earned now and the tax is payable now. That is what we call current tax. The capital gains as well is a little bit simpler, in the sense that if I sell my land today, I should pay Zimra right away. So for actual disposals of specified assets, you then have to recognize or to calculate current tax. But if I have got my land now and I have remeasured my land and it has increased in value such that when I sell it in the future, I will be asked to pay capital gains tax, I should accrue a deferred tax amount liability in the current period. Let's come back again to accrual concept. The increase in the value of my land, as an example, from $100, from 100,000 to 120 has happened in the current period. So in my profit and loss, if it's investment property, I can see an increase in other income, as an example, of 20,000. If it's land and buildings under PPE, I can see a revaluation of 20,000 in the other comprehensive income. So it has been earned now, but the payment will happen in the future when I sell that building. So that tax is accrued now but payable in future, hence deferred. Dividend tax, exactly the same. If I receive a dividend today, then I have to pay current tax today for that dividend income. Whereas if I have earned profit from an associate or my joint venture has increased in value and I expect to get dividends in the future, I've earned the income now, but I'll pay the tax when the dividend has been earned. Now, when you look at our tax expense, the component, therefore, of the tax expense is a summation or a composite of the current tax. Let's go back. Current tax, which is for the income earned in this current period, which is supposed to be taxed in this period. Also, the tax expense or deferred tax expense, which is for income earned in this period, which is supposed to be paid in future. So to summarize again, all the income that has been earned in one accounting period has to be taxed. But the timing of payment differs. What is payable now is put under current tax. What is payable, the tax that's payable in the future, is put under deferred tax. However, from an accrual, the tax expense should show the total tax charge for all the income that has been earned in the current year. So, at an overall level, when you look at the Zimbabwe tax expense, it talks to the normal corporate tax for income from trade, and you charge the current tax and the deferred tax. We'll go into detail for each. And for capital gains tax for income that has been earned, other income from buildings, sale of buildings and other specified assets, we've also got current and deferred. For if an entity earns dividends income, we also have got current and deferred as explained. If there are any questions, you can see the detailed explanation in the textbook around these issues.